Hi everyone, welcome to our lecture 6, which should be our accounting for liabilities. So officially, we're transitioning to the other side of the balance sheet. So previously, we tackled how to account for non-current assets, and after that discussion, we're officially done taking a deep dive into the asset portion. So we're done talking about our current assets, which would be your cash, your receivables, your inventory, and now we're gonna be moving on to accounting for liabilities. So going back to the very first lecture, the general idea naman or the God account equation for accounting would be everything that you own, which are your assets, has to come from somewhere, right? So either you're financed by your liabilities or something that is lent by a third party, or it is something that you put up as an owner. So that would be your equity. So going back to the definition, one of the things that I need you to master would be what is the formal definition of liabilities. So the general idea here is that there will be a past event wherein it will bring forward a present obligation from the entity. And because as the name suggests, meron kang obligation to do what? That would eventually result into an expected outflow. So kaya siya tinawag na liability because meron kang obligation na kailangan mong gawin and that would result into an outflow from your economic resources. So to further understand this, we need to be able to compare and contrast liabilities and equity. So number one, maturity date. Only liabilities have maturity dates because like what we mentioned, there is a present obligation versus equity na it's put up by the owner. So wala naman silang obligation to meet anything at a particular date. Second would be, like what I mentioned, who provides the funds, right? So in liability, you'll have creditors, and creditors are typically third party. When we say third party, they are outside the economic entity. And because they're outside and nagpautang lang sila, they do not have the right to control. In contrast, when you have equity providers, they're the part owners, right? So therefore, they have the right to control. So the next question would be, okay, they provided you with funds. Now, when it comes to paying them back, who has the better claim? So let's say you have limited assets, right? So let's say you only have 100 pesos, right, in your asset. So 100 pesos na lang. Now, in terms of like closing the books, parang you need to pay back both your liabilities and your equity. Pag isasara mo na yung company. Let's say your creditors parang need or demand 100 pesos from you and your equity provider, your owners, need 100 pesos from you. So, paano mo babayaran yung 100, right? Yung 100, ang mas may superior claim nun would be your liabilities or your creditors versus those that have inferior claims, which would be your owners. So, ang general idea is, babayaran mo muna yung sa labas bago paghahatian yung mga natira ng mga internal owners. And then finally, in terms of like what they get, creditors will get interest and that's why pinapautang ka nila. And those that put up capital, what they expect would be compensation in the form of dividends. So those are the differences between liabilities and equity. So another thing that we need to master is, okay, we already understand what liabilities are. We know why they're different from equities. How do we then classify them? So there are two ways to classify liabilities. You have your current and non-current. So the idea here is that there are four possible scenarios on how it would fall under current liabilities. And then if it doesn't fall for any of the four, then automatic, that would be a non-current liabilities. So the idea here lang naman is that current liabilities, when they're due, is very imminent or very short term. So what are those signs na short term siya? Well, one, if you need to settle within your normal operating cycle. So going back in terms of merchandising operations, kapag isa lang siyang cycle in terms of like how to get cash from like selling your service within the normal means of that operating cycle, and kung kailan mo yun kailangan i-settle, then that would fall under current liability. Another reason is if you're holding that liability in the purpose of trading it, then that's a current liability. And then the last two would be revolving around the 12-month rule. So generally, as the name suggests, so diba, within 12 months, if you need to settle that liability within 12 months, then that is a current liability. And then also, kung wala kang right to defer. So parang mayroon naman kasing instance na, okay, sorry, it's 2018, December 31. I need to pay sa December 31, 2019. So, you'd think, okay, current liability yon. But if the creditor tells me na, okay, hindi, actually you have the right to defer and bayaran, you have the right na pwede mong bayaran by December 2025, that's more than 12 months, and that would be non-current. So, the idea here is that it has to be settled within 12 months, and dapat wala kang right to defer. If you have the right to defer to extend it more than 12 months, that would be non-current asset. So, the general idea is just familiarize yourselves with these four concepts so that you know which are current liabilities, and then the rest would be non-current assets. So, in terms of measurement, generally, current liabilities are initially measured at present value. What does present value mean? Ang ginagawa is that tinitingnan nila, ano ba yung mga expected cash flows ko from that particular liability? So, let's say in the form of a bond, right? So, sa bond or any note payable, ang nangyayari is, okay, meron kang kailangang bayaran na interest, and then at the end, babayaran mo yung buong principal. So, in half 1, half 2, interest 1, interest 2, and then all the way until the date of maturity date, babayaran mo yung principal. So, you'll have different cash flows at different times. The idea here is you bring them back to its present value, and that is how you measure your liability. Now, it sounds complicated, especially when I'm just explaining it without visuals. And that's correct. So in practice, pag current liability, rather than present value, they're just assuming na, oh, the present value will be equal to the face amount of the current liability. So in practice, I just want you to know na, okay, the strict rule is dapat they are initially measured at present value, but generally, they're already recorded at face amount. So that's initial recognition. The next would be in terms of subsequent recognition. For subsequent, you just have to measure them at amortized cost. And that's something that we'll discuss in the next few slides. So now that we know the foundation when it comes to liabilities, we can now take a deep dive into the first type, right? Our current liabilities. And current liabilities actually is not something that's really foreign to us. We've already tackled a lot. Your accounts payable, your accrued expenses, your unearned revenues, your note payable, your interest payable, those are all familiar. So what I want to focus on would be these new concepts or new types of liabilities and how to account for them. Specifically, ang mga tanong lang naman sa liabilities is ano ba yung mga related expenses and ano yung mga related liabilities coming in from each of the accounts, right? So now, let's take a deep dive into each of the new types, starting with premium liability. So what are premium liabilities? So premium liability is very interesting because the name premium actually misleads people na, isn't premium parang more of like an asset? Well, generally, ang textbook definition is, what are premiums? Premiums are coupons or anything that's article of value. So, towels, knives, basketballs, mga free items na binibigay nila because of a sales promotion. So, I think the closest example here is that if you're in the department store or in your in another typical shopping outlet, parang when you're buying, they'll entice you na, oh, pag bumili po kayo nito, or parang if you return these bottle caps, you'll get a chance to get an item. So, yung free item na binibigay nila sa'yo is what you call your premiums. And generally, what I just want you to be experts as would be two things. Know how to record your premium expenses when you actually distribute it to your customers. And then know when to recognize kailan ba nagkakaroon ng liability when it comes to these premium expenses, right? And honestly, the format lang naman of today's lecture would be, I'll explain to you the definition, so I'll give you your journal entries, but I think mas hardworking is just really master the exercises that I will be sharing for each of the accounts. So with that said, let's start. Our first sample would be our premium liability when it comes to our manufacturer, right? So these are the given. What do we need to do now, right? So what does it say? So merong entity na nagma-manufacture sa ng certain product and then binibenta nila ng 300 units. So that's the main product. The idea here is that in order for you to be enticed, they're offering you, okay, pwede ka namin bigyan ng soup bowl, right? Pero there are some conditions. First is, kailangan mong ipakita sa amin that you consumed 5 of our products as as evidenced by the wrappers or bottle caps that we will give you. And then, you will get or remit the 10 pesos. So, how does it work? Bumili ka, and then for you to claim the premium, which in this case is a soup bowl, all you have to do is provide 5 wrappers plus 10 pesos. So, magiging 10 pesos na lang yung pagbibili mo dun sa premium. Right? So, what are the other information? Right? So, the bowl costs 45, pero may delivery fee rin na 5 pesos. And that, 60% of the wrappers will be redeemed. Right? And then these are just sales data. So, the first thing I want you to do when you encounter premium liabilities is, syempre, we're talking or focusing on the premium, the soup bowl. And the thing that I need you to first understand is, magkano ba yung net cost of your premium? The net cost means, what are the different costs that are associated for you to be able to bring it and bring it to its full intention, and then less any remittance na ibabayad sa ni customer. So, in one soup bowl, ang ginastos natin is the 45 pesos, the actual cost of the bowl, the 5 pesos na delivery fee per bowl, and then isusubtract natin yung remittance. So, every bowl na we encounter, mayroon siyang net cost of 40 pesos. So, that's the first thing I need you to understand. Pag may nakita kayong premium, automatic first step is get the net cost per premium. From there, you will be able to get ano ba yung premium expense and premium liability mo, right? So let's first start with, right, how do you get your premium expense, right? So step 1 is the premium expense will come from our estimate, right? So basically, it's saying na parang what are the actually, so pag expense, what are the amounts of premiums that have been redeemed, right? So ano ba yung actually na-redeem? So out of na nabenta nila, 4,000 raw yung nag-redeem nung soup bowl. So the question is, yung 4,000 na wrappers na yun, ilang soup bowl yung kailangan mong i-distribute? Hindi naman 4,000 because there is a conversion factor. For every 5 wrappers, they will give you 1 soup bowl. So the step 1 is get the number of premiums that have been redeemed, which would be the 4,000 wrapper, so yun yung mga nag-submit, divide mo by 5, and technically, you will get 800 bowls na have been redeemed. And because na-redeem na sila, that is when you will multiply that to your net premium cost of 40 to arrive with your premium expense. So what does the journal entry look like? So step 1, we need to credit premium at cost. So the cost is 800 times 50. So saan ang galing yung 50? It's the 45 cost plus delivery fee. So 50 siya times 800, you will get 40,000. So that will mean that you will credit your premium kasi dinide-recognize mo na yung asset. The second step is to debit the cash. So the amount na niremit sa'yo. So 'di ba, in order for you to claim the bowl, you will have to pay 10 pesos per bowl. So 10 pesos times 800, technically you received cash worth 8,000. The one that we have to squeeze in between, yung missing debit, refers to your premium expense, right? So 32,000. So that is usually kung ano yung hinahanap. How much is the premium expense for the premium example? And then the last step is gagawa ka ng estimated premium liability. And how you solve for the estimated premium liability will be as follows. So step 1 is you determine ano ba yung balance. And what do I mean by balance? Kaya nga, as the name suggests, you always start with an estimate. So the estimate here is that in terms of the total volume of sales, which is around 10,000, ang initial estimate is 60% yung magki-claim. So yung estimated to be claimed is around 6,000 wrappers, right? So yun yung 6,000, yun yung initial estimate. Pero in actuality, ang nag-redeem lang are 4,000. So out of the 6,000 estimate minus 4,000, may 2,000 kang unaccounted for. That outstanding estimate is what we will record as your premium liability. So, what we will do is, okay, 2,000. Ilang premium yung makukuha ko from 2,000 wrapper? So, we follow the same exercise. So, 2,000 wrappers divided by 5, we technically have to get an allocation of an extra 400 bowls na kailangan nating gastusin. So, how to record this would be, first is determine the next net expense, which you already did, which is 40. We then multiply that by the remaining bowls that we have to distribute. So in this case, it's 40 times 400. You will then credit a estimated premium liability of 16,000 and debit a premium expense. So putting those two together, those two journal entries, you will arrive with your total premium expense and total premium liability for the year. Kindly take note na in journal entry 2, you have 32,000 premium expense. In journal entry 3, 16,000. So ang total talaga is 48,000. And that 48,000 represents your initial estimate. So the 32 came from the 800 bowls that were actually redeemed. And then the 16,000 came from the 400 that was still outstanding. Pero pag in-add mo yun, 800 plus 400, you'll get 1,200. That's the initial estimate. So premium expense is coming from the initial estimate of 60% to be redeemed. The premium liability will only refer to those that are remaining outstanding. When we say outstanding, it's the ano ba yung estimate mo? I-subtract mo yung actual, yung remaining outstanding estimate will be equal to your premium liability. Okay, it sounds confusing, but again, I will redo this problem, right, using a shortcut. So, dalawa lang yung hihingin sa inyo. What is the premium expense for the year and what is the estimated premium liability? So, first is, how do you get your premium expense? So, step 1, you always start with determining ano ba yung net premium cost, which is 40 per bowl. The next step is, kailangan mong alamin ano ba yung total estimate for the year. The total estimate for the year will then provide you the quantity of premium. So, quantity of premium times the net premium cost of 40 will be equal to your premium expense. So, ano yung how to operationalize this? So, step 2, you estimate you get the estimate of ano ba yung initial nilang guess on how much would be redeemed. Sabi dito, 60%. So, out of the 10,000 that were sold, 60% will be redeemed or claimed or remitted, and that will be 6,000 coupons. However, don't forget na you have to convert those coupons. Hindi naman yung coupons yung kinokost natin, yung premium na soup bowl. So, what we need to do is, from the 6,000, we know that you need to remit 5 to get a soup bowl. So, 6,000 divided by 5 will give you 1,200 soup bowls, which I said earlier. And that 2 soup bowls, we just multiply by the net premium cost of 2 times 40 will give you your premium expense of 48,000. On the other hand, if you're interested in getting your premium liability, all you have to do is get your outstanding coupons. So, you start with your initial estimate. Okay, so kanina sabi mo 6,000 yung coupons na mariredeem feeling ko. But actually, ang na-redeem lang is 4,000. So, mali ka or may excess estimate ka of 2,000. And again, hindi yung coupon yung hinahanap natin, but yung premium. So, we have to convert the coupon by 2,000 divided by 5, which should be your 400 estimated soup bowl. So, 400 times 40, the net premium cost, will give you your estimated premium liability. So, basically, that would be your overview when it comes to your premium liability. So now we go to the next type of current liability that we haven't discussed, which would be provisions. So the most common example of provisions are warranty, but kindly note that warranty is just but one example of what provisions are. So before going into the specifics of any warranty, let's discuss what makes a provision a provision. So just like any other liability, it is really a present obligation that usually arises from a sale obligation, particularly kung warranty siya, right? But what really makes it a provision is that meron kang probable outflow, right? And the key term here is probable. Kailangan probable siya, hindi highly likely, hindi might, or baka. It needs to be probable. And for it to be probable, it has to be above 50% chance that it will result into an expected outflow. However, it's not enough. Kailangan meron kang reasonable way to measure it or to estimate it, right? So that would be the general definition. So now we go to warranties. And honestly, the way you account for warranties is very similar to how you account for premiums, right? So how you account for premiums. So generally, what you will do is you will get an estimate, and that will be the basis for your warranty expense. So you will have debit warranties expense, credit EWR or expected warranty liability. And then, pag nagkaroon ka na ng actual warranty costs, babawasan mo yung liability estimate mo. So, that would be debit EWL, credit cash. And then, either mag-adjust ka ng EWL for any other change in estimate. So, pag tumaas yung estimate, credit EWR. Pag bumaba yung estimate, debit EWL. Right? So, to further understand this, let's look at this example. So, the general idea here is that for warranties, merong three major parts, right? So first is yung base sale. The first paragraph talks about the base sale na nagbenta ka round ng 1,000 television set, right? Doesn't matter how much, the idea is nagbenta ka. And the second paragraph talks about the second portion, which is your initial estimate. Ano ba yung probable expected outflow from this warranty? Ang sinasabi niya is that, okay, meron kang one warranty per set na nabenta mo. But hindi lahat yun will result into an expense or a liability. Only 60% will be probable in terms of expecting an outflow. So therefore, yun lang yung i-account natin. And then, the third part is, ano ba yung actual? So, the second paragraph talks about an estimate of what is probably gonna be asked for the client. But the third paragraph will tell you, ano ba yung actual? And with these two information, you will now be able to solve for your warranty expense and your warranty liability. So let's go first muna sa journal entries, right? So first is, how do you get your warranty expense? So you start with, ano ba yung probable estimate? So it says na, okay, 1,000 set, may probability na 60%. So therefore, out of the 1,000 sets, 600 lang pala yung magre-redeem ng warranty. The question is, okay, that's the volume. How much should we cost it? Well, sabi nila, it's 500 per warranty claim. So therefore, your warranty expense should be 600 times 500, which will be 300,000. So the journal entry would be debit warranty expense, credit EWL of 300,000. Next is, okay, tapos na tayo sa estimate. But what actually happened? What actually happened is that 180,000 lang pala yung na-claim. So we have to lessen our estimated warranty liability by debiting it by 180,000 and crediting cash of 180,000. So now, with this, we will be able to get our current liability under warranty liability, which is 300 credit minus 180 debit, so net 120,000. So again, ang hinahanap lang dito is your warranty expense and your warranty liability. So again, I'll teach you a shortcut. But the general idea is, yung warranty expense is tied to the estimate. So kung ano yung probable 60%, so that is the estimate, will represent your warranty expense. And then your warranty liability represents your outstanding. Ano yung difference from your estimate to the actual? Yung outstanding, that would be your EWL. Yung gap will be your EWL. So redoing the problem, pag hinahanap lang sa inyo yung warranty expense, all you have to do is get the probable estimate is 600 times any other cost that's associated per unit, right? So that would be 500 times 600, 300,000. That's your warranty expense. Yung EWL naman is simpler. You just get the estimate, subtract your actual, and then you will get your liability. So estimate of 300,000 minus actual of 180, you will get your EWL of 120,000. So that's basically your warranty. So that's your second type of exercises. Pero, let's go back. That warranties is just but one example of provisions. Merong provisions that look like this. Specifically, when you have legal cases, right? So legal cases, hindi mo naman alam how the judge will rule. However, you can make an accurate estimate. So here, the first thing that you have to ask is, provision ba siya? For it to be a provision, it has to be above 50% chance. And according to this, meron kang 60% chance ulit. Now, for it to be a provision, it checked the probable cost, but is there a way to estimate it reliably? Yes, may binigay a lot of information. For this, we will need to solve your expected value. So expected value is using the probability outcomes, you multiply that by your expected outcome so that you can get the expected amount. It sounds like a mouthful. It's easier to understand by applying this to the. So now let's answer this particular example. So for provision examples, I want you to break it down step by step. So step one is you ask yourself, is this a provision? And again, we do the test. Is it probable? Is it above 50%? The answer is yes, right? So anything above 50% is probable. So this is a provision. The next step is for us to measure it reliably, we need to come up with its expected value. So it looks like this. This is the expected value for this particular unit. The thing kasi here is that there are two tiers. The first tier is, will we win or not? There's a 40% chance we'll win, so we don't have to pay anything. And there's a 60% chance that we will lose and we have to pay. So tier 1 is, meron tayong 60% chance of losing. Tier 2 is, okay, pag natalo tayo, there are two scenarios. Either magbabayad tayo ng 4 million, that's a 30% chance, or meron tayong 70% chance that we'll pay 7 million, right? So the thing is, from the 4 million to 7 million, we have to adjust this based on their weight, the probabilities. So first is you start with tier 1 probabilities or your general probability na matatalo ka, which is 60% across the board. Kaya 60% yung unang i-multiply. The next is your specific probability, which is your 30% and your 70%. And then lastly, sa 4 million. So sa 4 million, it's 60%, which is the chance na matatalo ka, times the 30% chance that you'll get 4 million, that you'll have to pay 4 million. So 700,000. That's the expected value for that particular outcome. For the second outcome of 2 million, again, it's 60% chance na matatalo ka, so that's the general, times the specific of 70%, times the 2 million outcome, you will have an expected value of 840. When you add those two together, meron kang 1.5 million, 1,560,000 na kailangan bayaran. We're not yet done. Meron ka pang i-adjust na risk factor. So the idea lang here is, this is your expected value, pero you wanna multiply this to a risk amount or risk factor. So it says here that there's a 10% risk factor. So all you have to do is using the 1,560,000, you multiply that by 10%, you have to add an additional risk adjustment of 156,000. So ang total reasonable expected cash outflow here is the 1,560,000 plus 156,000. The answer is current liability is 1,716,000. So that's how it works. So step 1, know if it's a provision. Step 2, get the expected value. Step 3, make adjustments for risk or any present value implications. Again, that basically illustrates that these are the key requirements for provisions. So the related idea or topic with provisions is what we call contingent liabilities. So bakit natin kailangan i-differentiate? Because sa provision, you have to make a journal entry, you have to record it, you have to disclose, you have to record it. So contingent liability, you do not have to make a journal entry, right? And you only need to disclose it. So ano yung difference? Kapag probable siya and measurably reliable, it's a provision, right? However, if it's just probable pero hindi siya measured reliably or measured reliably siya pero hindi siya probable, this is just but a possible obligation. So provision is a present obligation, so you have to record. But if it's a possible obligation, meaning it's not probable or hindi siya measured accurately, it's only a contingent liability. And contingent liability means that i-disclose mo lang siya. So no journal entry, right? And then the last portion for current liability is, okay, we're done now with warranty liability, premium liability, and then other provisions, and then differentiating it with contingent liability. The last thing I want you to master is knowing that the last current liability that you have to recognize is the current portion of a long-term liability. So basically, the idea here is that you will have a base long-term liability, pero may portion siya that will fall within 12 months na wala kang right to defer. So the question is, look for the cut-off date. So an example of this is Able Company. So Able Company, you'll see that they have various different long-term liabilities as evidenced by your 14% note, 11% note due 2020, 8% note that has 11 equal installments, and a debenture. So these are just fancy terms for long-term liabilities, right? So the step lang here is that first is determine the cutoff date. The cutoff date is December 31, 2017. Therefore, our cutoff date is 12 months after that. So 2018. So anything that falls before December 2018 and you do not have the right to defer will fall under current liab. So now let's look at each. First is the 14%. It's due 2018. So therefore, it falls within the date. So therefore, it's a current liability. Next, meron kang note na due 2020. So that's above the cutoff date, so we don't include. Next one is the tricky part. Meron kang 8% note that is due in 11 equal annual principal payments. So meaning, every year, for the next 11 years, magbabayad ka ng 11 equal installments. So if our total utang is 1.1 million, divide mo by 11, every year, meron kang kailangan bayaran na 100,000. This is where makikita nyo that there is actually a current and non-current portion. Yung out of the 11 installments, the next installment that is due within 2018 will fall under current liab, and then the next 10 installments that's due 2019 onwards, non-current. So ang current liability here would be 100,000. Right? And then yung debenture, wala namang sinabi. So we will ignore. So meron sasabi na meron kang additional requirement, etc., etc. But the idea is, doesn't matter. It's due 2019. So this is not current liability. So your current liability is 600,000. So the idea lang here is, you have to be careful to determine ano ba yung mga current portions of your long-term liability. And you have to classify them accordingly as current liabilities. And with that, we're officially done when it comes to our current liabilities, right? So we now officially move on to our non-current liabilities and the bulk or the meat of our topic, which would be bonds payable. So, like what I mentioned, yung current liabilities, those are something na I hope ma-master nyo. But the challenging part here is really bonds payable. So I hope na in the next few slides, you pay attention in terms of how we break it down, ano ba yung mga key concepts, and then eventually at the end, how to amortize it, right? So first is, what are bonds? So bonds is basically a contract of debt, right? So meron kang unconditional promise na magbabayad ka ng specific sum of money at a determined future date, and then in between that maturity date, magkakaroon ka ng interest payment. So it sounds really familiar to our notes, right? However, si bonds, ang difference niya is that typically these are for large amounts and you borrow from the general investing public through what we call a bond issuance. So, kare, ako I'm a company. I need to raise funds. What I'll do is I will issue bonds and then I will open it to the public and then they can buy a portion of those bonds. So, they'll give me money in turn and then in turn, babayaran ko sila. Right? So, that's what bonds look like. So, it's very similar to, your receivables na in the sense that you have your issuer, which is basically the seller of the bond, and then your investor or your creditor. So, mangyayari is, I will give you this bond paper. So, this bond, right? So, what you will do is I will receive the face of the bond na I'm selling it to. But in exchange, I will promise to pay you interest and principal. So, one thing to note is that bonds are sold in equal domination. And this is called the face amount. So, usually, it's by 1,000 pesos, but sometimes it's by 10,000 pesos. So, to practice this, if I want to raise 5 million and then the face amount of bonds is 1,000 pesos each, what I'll have to do is sell 5,000 of those 1,000 peso bond coupons, right? So 5,000 times 1,000 is 500,000. So how do we measure bonds? We measure them at fair value which is basically equal to your present value or your face amount. So we measure it pa rin technically at present value. So fair value. And then we measure at either amortized cost or FVPT, fair value through profit or loss. So I will not focus on FVTPL, we'll focus on amortized cost instead, right? So let's now learn how to account for bonds. So the thing that I want you to understand with bonds, unlike yung mga notes receivable that we talked about, is that for bonds, there are two different interest rates that you have to know. Your nominal interest rate and your effective interest rate. Kapag na-gets nyo to, then you're gonna be set in terms of initial recognition and subsequent measurement. But you have to understand that there are two rates that they will give you. So now let's take a deep dive into these interest rates, right? So offhand, this is the thing that I need you to master. You have what you call your nominal or your stated interest rate, which will determine your interest payments for each of the periods. Yung interest payment, for the sake of this discussion, we will now call annuity. So this is a regular form of cash flows that you have to pay regularly. So that represents your interest paid. Now, iba ang interest paid sa interest expense. Interest expense is driven by your what you call your effective interest rate, which will then affect your issue price, which will be the ultimate determinant of how much your interest expense is. So, effective or yield rate sounds alien to you, pero mas familiar kayo sa stated or nominal rate. So now, let's put examples para maintindihan, right? Here in this base scenario, you have three types of bonds that have the same face amount, meaning in-issue siya na, kuwari, if it's 1,000, meron kang 10,000 na binenta, right? So, the face amount of all the three bonds are the same. 10 million, 10 million, 10 million. However, nagkaiba sila bigla sa issue price. Sa bond 2, sa bond 1, okay. Bond price is equal to issue price. Sa bond 2, 9 million na lang. Sa bond 3, mas mataas, 10.3. And then the reason is because iba sila ng effective rate. May 10%, may 12%, may 9%. So we'll talk about that in the next portion. What I want to focus on muna is the concept of nominal interest rate. So nominal muna tayo. They have the same nominal interest rate, which is 10%. So their interest paid is equal to 500,000 because this is paid semi-annually, right? So paid semi-annually to. Right? So, the idea here is that your nominal interest rate will dictate how much yung interest na babayaran mo for a particular bond. So, basically, for all three bonds, I will pay 500,000 because what I do is face value times the stated interest rate of 10% times the time factor. So, this case, dahil semi-annual, it's 6 over 12. So, that's technically 5% times 10 million is equal to 500,000. Right? So, basically, the idea here is that even though iba-iba sila ng effective rate, the nominal interest rate will remain 10%. So, kailangan yun yung interest paid nila. And therefore, your nominal or stated rate will determine ano yung cash flows mo for the life of the bond. So, because we were able to understand na 10% yung nominal interest rate niya, which is basically 5% per 6 months, we will be able to determine yung cash flows. Na in the first 6 months, magbabayad ka ng interest 1 of 500,000. In the second period, it's 500,000. And then dahil 2-year note, mayroon kang 4 periods. So, period 1, period 2, period 3, period 4. And then at the end, dun ka lang magbabayad ng principal. So when I ask you, ano ba yung composition of the cash flows for bonds, you will tell me, dalawa lang yan. You pay the principal at the end of its life, which represents 10 million, and then you pay a regular amount of interest that we call annuity every period. So, naging annuity siya kasi you pay 500,000 per period. So, yung annuity of 500,000, how we got that is through our nominal interest rate. Right? So, clear. The thing that determines your annuity and your cash flows is your stated rate. Yung effective rate, on the other hand, will explain bakit ka nagkakaroon ng difference in terms of the issue price. Meaning, bakit nag-iiba yung fair value of bonds that have the same face amount? Right? So why are issue price different from a bond that has the same face amount? It's because of their effective interest rate. Ayun o, nagkakaiba sila. Right? So now, let's take a deep dive. Right? So first is, issue price is the present value of all the cash flows that are associated with the bond. Kaya ko inuna yung nominal interest rate is because kailangan nyo munang intindihin na, okay, it's a 2-year bond starting from January 2017 to 2018. So may 4 periods ka. So sa June 30, magbabayad ka ng 500,000. Sa December 31, 500,000. The next year, again, 500, 500. So you have 4 cash flows for annuity and then 1 principal, right? So that is determined by your nominal rate. Your effective rate is the rate that you will use to discount this back to its present value. So ang ginagawa is, okay, we're at January 1, 2017. Itong cash flows na to is happening in the future. So what you have to do is bring that back by multiplying a specific present value factor so that babalik siya to its present value and that will determine your issue price. It sounds complicated, but I think by doing this example, we will be able to get a clearer idea. So the idea lang here is that effective interest rate will drive the PV factor for your cash flows, right? So let's start. Let's master getting the issue price. So first is, ito yung cash flows for this particular bond, bond 1, right? Pare-pareho lang naman yan sa bond 2, bond 3. Right? The next step is we need to understand na, okay, there's 2 cash flows, an annuity, so it happens at the regular periods, semi-annual interest, and they have principal that happens at the end of the period, so 10 million. Step 2 is we need to know how much yung PV factor that we need to multiply, right? To be able to bring it back to its present value. So basically, what we have to do is annuity of 500 times the PV factor, principal of 10 million times the PV factor. So don't worry, rather than making you compute manually, I will give you a PV factor table. Right? The question is, out of all of these figures, ano yung i-multiply natin to arrive with our issue price? So how to help with that is first, know the periods on how frequent the interest is paid. So here, it said semi-annual siya for 2 years. So technically, that would be 2 years divided by 2, 4 periods. So lahat ng hindi nagsasabi ng 4 periods, tatanggalin natin. So ito says for 2 periods, so tatanggalin natin. And this one says 2 periods, so tatanggalin natin. Right? Step 2 is, now that we know 4 periods, the question is, ano gagamitin natin? Times 10% ba or 5%? The thing is, right, we want to bring it back. The PV of the annuity for 4 periods and the PV of the PV of 1 for 4 periods. But the next question is, but at what rate? 10% ba o 5%? Right? Well, you have to follow kung ano ba yung effective rate that is adjusted on the frequency. So ito, the effective rate is 10%, pero technically, we have to adjust that by the frequency. So kung semi-annual, that would be 10% times 1/2, which is equal to 5%. So now we will be able to eliminate na, okay, the PV factor is 4 periods at 5% and 4 periods at 5% for both annuity and period. So we just plug it in. So basically multiply the PV factor to the relevant cash flow. So first is value of 1 of 0.8327. I-multiply natin yun by 10 million to get 8,227,000. And then the 3.54, we multiply that to the annuity. And then that will give you 1.773. Pag in-add mo yun pareho, you will get an issue price of 10 million. And then by this point, you'll be like, grabe, sobrang complicated nung ginawa natin. Same lang pala as the face amount. Well, the thing that I want you to learn is that this is the most basic type of bond, which is what we call our issued at face. The reason why same yung carrying amount and face amount is that if you notice, pareho rin yung nominal rate and your effective rate. So the idea here is that if your nominal rate is equal to your effective rate, then your carrying amount or your present value is equal to your face amount. So they have the same nominal rate of 5% semi-annual and effective rate. So same rin yung face and issue price nila, right? Issue price will determine your carrying amount. So how to journalize this is debit, cash, credit, bonds payable, 10 million. So happy tayo if this is the base scenario. However, we will now introduce more complicated versions of bonds. Merong bonds that are issued at a discount. What happens is the carrying or the present value is lower than the face amount. And this is because your stated rate is lower than your effective rate. So palagi, our basis is stated rate. Pag mas mababa siya than the effective rate, then that would be a discount. Pag mas mataas siya, that would be a premium. So let's go to the discount. So ito yung bond 2. Our nominal rate is less than our effective rate. So therefore, magkakaroon ka ng discount. So again, it doesn't matter what your effective rate is. Your step 1 is to determine the cash flows using the stated rate. So, same yung cash flows, right? Annuity of 500,000, principal of 10 million. The question is, paano ba natin ipi-PV factor yung cash flows na to? We will use our effective interest rate, right? So which one, right? So again, we look at how frequent. So again, semi-annual, so 4 periods. So okay tayo na, okay, for 4 periods and 4 periods. The next question is, anong gagamitin natin? 5% or 6%? We always use the effective interest rate to get the PV factor. So adjusted by the frequency. So yung 12% semi-annual is 6%. So hindi yung 5% ng nominal rate, but yung 6% yung gagamitin. So we delete that. So we now know the PV factor. So it's 0.79 times 10 million, 7921. And then for the annuity, it's 3.4651, 1.7. Pag inad mo yan, that would be 9,653,550,000. That will be your issue price, which is lower. So, again, dahil lower yung nominal rate natin than our effective rate, it will result into a carrying amount that's less than the face. How do you journalize? So, again, you journalize by crediting the bond at face amount. So, same pa rin, 10 million. Pero now, you will debit cash. Kasi yun yung na-receive mo lang eh. Ang na-receive mo lang pala is 9,653,000. Anong gagawin natin dun sa botal? We will call it a bond discount at 346,450, which will be treated as a loss that we need to amortize throughout the life of the bond, right? So finally, the last would be for premium. So baliktad naman. Your nominal rate is higher than your effective rate, so therefore your carrying amount or the cash you will receive will be higher than your face amount, right? So again, we understand that the same lang yung cash flows nila. The annuity is dictated by your stated rate. Yung PV factor, alam natin 4 periods. And then we will now use 3%, right? Kasi yun yung effective rate na semi-annual. So 10 million times 0.8548, you will get 8,548,000. And then the other one is times 3.6229, will give you 1.8. So now your issue price is 10,362,000, which is higher. So again, this is a bond issued at a premium. So dahil mas mataas yung semi-nominal rate than your effective or yield rate of 3%, you will now have a carrying amount that's higher than your face amount. So how to journalize this is again same. Step 1, credit 10 million of bond payable. Step 2, debit cash at issue price, which is 10 million. So now mayroon tayong missing credit, which will now treat as bond premium. So this is treated as a gain that we will then recognize through the life of the asset. So by now, you are now experts at the initial recognition. So initial recognition, either you will recognize it a bond at face, a bond at discount, or a bond at premium. The last step is coming up with the amortization tables, right? So again, I will just explain to you the process and then I will help you be able to determine ano ba yung typically hinahanap, right? So first is, let's go to scenario 1, bonds issued at face, right? So, meron tayong 2-year bond that has a nominal interest rate of 12% semi-annual. So, technically, that should be 6%. May face amount siya of 5 million. And then may cash proceeds siya of 5 million. So, cash proceeds is equal to issue price. So, same lang, right? This is what the amortization table should look like, right? So, number one is, what I want you to do is step one, create a table that has the dates, wherein ito yung mga dates that they'll pay interest and also have to return the face amount. And then second would be to write the different columns. So you have interest paid and interest expense, and then you'll have amortization and then carrying amount. So step one is you write your carrying amount here at 5 million in comparison to your face amount. Step 2 is I want you to list down the interest paid. So ano ba yung mga cash flows? So how to get that is 5 million times the semi-annual interest rate of the nominal rate of 6%. So 6% times 5 million, you'll get 300,000. So the idea here is that interest paid will be the same throughout the periods. So 300,000, 300,000, 300,000, 300,000. Saan ang galing yung interest expense? The interest expense is, how we got that is, we multiply the carrying amount of the previous period times the semi-annual of the effective rate. So 6% times 5 million is 300,000. Wala silang difference, so wala tayong i-amortize. And therefore, the carrying amount will remain the same. Kaya same lang yung interest expense. So per bonds at issue that face, your interest paid will be equal to your interest expense because your nominal rate is equal to your effective rate. If it's issued at a premium, iba na yung itsura ng amortization table. It looks something like this. Right? So again, what I want you to notice is that we always start with the face amount and then you look for the cash flows. So, ito yung mga cash flows. So again, it's 6% nominal or stated rate multiplied your face amount will give your interest paid. Your interest expense is multiplied how? You get your carrying amount, which is the issue price, multiply that by the semi-annual interest rate of the effective rate. So magkaiba yung rates nila. You'll get 214,000. So ang nangyayari here is that yung interest expense mo is 214,000, pero ang binabayad mo is 300,000. So the difference is negative 85,000. This negative 85,000 that you pay in excess is what is used to reduce the amount. Diba, initially, 5 million lang yung face. Para mapababa siya to 5 million at the end of the period, we need to amortize the premium as they come through the interest payments. So what will happen is that yung format mo lang is 214,520 minus 300,000, 85,480. We add that to the carrying amount, you'll get 5.277 million. And then step 3, i-multiply mo ulit by the effective rate. So 4% of 5.277 is equal to 211,000. Yung 211,000 you compare to your interest paid. Again, this is negative 88,900. So, ibabawas mo na naman from the 5.2, magiging 5.1 na lang. 5.1 times the 4% is 207,544. We compare that with the 300,000. This is less than 92,000. Negative 92 plus 5.8 is naging 5.098. We multiply that 4%. And then eventually, bababa siya to 5 million. So, ang mga tanong lang dito would be as follows. First is, how much is the interest expense for June 30? So, titignan nyo lang here, 214,000. Or how much is the amortization at December 31, 2017? 88,900. So, ganun lang yung mga tanong. Or what is the carrying amount at December 2018, which is June 30, 2018, which is basically 596. So it's all about creating the table. And then from the table, you can answer any of the questions. So lastly, we will now look at the discount, right? So discount, sinabi na dito yung issue price is less than your face amount. And the reason why is because your nominal rate of 6% semi-annual is less than your effective rate of 7% semi-annual. So let's make the table, right? How do we create this table, right? Step 1 is list down your face amount, which is 5 million. And then you determine your interest paid for all the periods, which is basically the stated rate, so 6% times the face amount. So 300,000 siya, all of the periods. So the interest paid has to be the same for each of the period. The next step is to know the carrying amount naman. So 4.83 million. So as you can see, biglang tumataas si 4.8 all the way hanggang tumaas siya sa 5 million. The reason why is we amortize the discount. How to do that is 4.8 multiply mo by the effective rate of 7%, it will give you this number. And then you notice 338 minus 300, meron kang premium of 38,000. Sorry, meron kang ina-amortize na bond, so tumataas ng 38,000. So you add that to the 4.83, magiging 4.868. You multiply that again by 7%, magiging 349,815. So that is an excess of 40,000. I-add naman yun to 4.868, magiging 4.9, and then you do as follows until tumaas sa 5 million. So again, the questions here would be, how much is the amortization discount at June 30, 2018? So it's 43,670. So with that, we're done with coming up with our amortization tables for bonds, whether it's premium, issued at face, and discount. So in terms of the preparation for the quiz, I will then upload the problem set and also the Excel file. So your goal is for you to familiarize yourself on how to answer using the Excel file and how the amortization is made, right? So I will first give you the problem set. You try to solve it on your own. And then eventually I'll give you the Excel file in lieu of our class discussion. And then if you have any questions, we can schedule consultation. Yeah. So thank you so much, everyone. And I hope you learned a lot when it comes to liabilities.